Jake thought he was buying passive income. 20 years later, he realized he had accidentally bought a part-time job. Back in 2006, that sounded impossible. Buying a rental property looked like the smartest financial move you could make. Prices were rising. The real estate guys on YouTube had spreadsheets showing $400 a month in cash flow. Everyone at the meetup had a story. Jake had $50,000 saved and a decision to make. His friend Marcus had the same $50,000 and a different question. Not which property, but do I actually want to be a landlord? That single question, asked at a lunch table in Austin in 2006, separated two people who started in exactly the same place. This is the Ben factor. Same salary, $60,000 a year. Same city, same savings, college friends who still grabbed lunch every few weeks. Jake had been watching the real estate guys on YouTube. He went to a meetup, the kind where everyone wears a polo shirt and talks about cash flow like it is a personality trait. He ran the numbers on a rental in a decent neighborhood. $250 purchase price, $50 down, 7% on the mortgage. His payment came out to $1,331 a month. He found a tenant at $1,800. On paper, $469 a month in cash flow before he touched a single bill. Jake felt like he had figured something out. Marcus listened to all of this over lunch. He asked one question. What happens when the roof goes? Jake said he had a reserve fund for that. Marcus said he did not want to think about roofs. Jake laughed. He thought Marcus was being overly cautious, maybe a little lazy. Marcus took the same $50,000 and put it in a total market index fund. Set up a $300 automatic transfer every month. Closed the app. Ordered dessert. Jake had a house, a tenant, and a story. Marcus had a confirmation email and a clean Saturday. For the next 3 years, Jake was the interesting one. For the first 2 years, Jake is living exactly the life the YouTube guys described. Rent hits on the first, he drives past the house on the way to work, his house, his asset, his tenant inside. He writes off depreciation at tax time. He tells people at work that he is building passive income. The contractor knows him by his first name. He starts recognizing the Home Depot cashier. He tells himself, this is what ownership looks like. Marcus logs in once a quarter. Year 1, $55,000. Year 2, $61,000. Nothing to talk about. No key in his pocket, just a number on a screen that goes up a little, dips, and goes up again. Jake wins every conversation. Marcus orders another beer and changes the subject. Social proof is not math. It just feels that way. A lot of people have had this lunch. Year 3, Jake finally stops looking at the cash flow calculator and starts looking at his bank account. The numbers are not matching. Over 36 months, he collected $64,800 in rent. His mortgage payments were $47,880. On paper, a $16,000 profit. Then reality showed up. Property taxes, insurance, a water heater that failed in month 14, a roof leak in year 2, a vacancy month that cost $1,800 in lost rent before he even touched the cleaning bill. And Jake manages the property himself, which means the Saturday morning calls, the contractor who does not show, the tenant who texts at 11 p.m. about a running toilet and is not wrong to text. After every real cost, 3 years of owning a rental property had produced somewhere between $2,000 and $4,000. Not $16,000, $2,000 to $4,000. Marcus is at $79,000. 0 calls, 0 repairs, 0 Saturday mornings at the hardware store. But before you write Jake off, there is something a simple index fund genuinely cannot give you. Jake used $50,000 to control a $250,000 asset, 5-to-1 leverage. When the property appreciates, Austin averaged roughly 3.5% over this period, his equity grows on the full $250, not just the $50 he put in. By year 3, the house is worth $277. His equity has climbed to nearly $84,000. A simple index fund cannot do that. Marcus's $50,000 grew to $79,000 in 3 years. Jake turned $50,000 into $84,000 in equity, on paper, in the same window. At the year 3 lunch, Jake pulls out his phone and shows Marcus the equity number. Marcus looks at it for a moment. Then he asks how many Saturday mornings it took. Jake says he does not track it, which is already the answer. Marcus orders coffee. He does not look impressed. Here's what nobody at the real estate meetup tells you. Leverage works in both directions. Every repair, every vacancy, every tax bill, those hit you whether the investment is performing or not. You borrowed against a single asset in a single zip code. If that zip code has a bad decade, you are concentrated in exactly the wrong place. Saturday morning, year 7. Jake had plans. His phone buzzed. The upstairs toilet is leaking. Marcus went golfing. Jake went to Home Depot. This was not unusual. In Jake's case, roughly 300 hours a year went into the property. Showings, repairs, communication, accounting, tax prep, the 2 months a tenant disputed the deposit. 300 hours is 7.5 full work weeks, every year. Jake is not a passive investor. Jake is a part-time property manager who is also paying the mortgage on the office. Marcus asked the question nobody at the meetup ever asked. If Jake had taken those 300 hours and done anything else, even if he could have earned $50 an hour, that is $15,000 a year in foregone income. Over 20 years, that is $300,000 that never shows up on the rental property spreadsheet. $300,000. That is the invisible cost. The one that does not appear in any cash flow calculator. The one the polo shirt guys never mention. Jake had done the math on the house. He had never done the math on himself. Here is the strange part. Jake actually beat the stock market for a while, and it still was not the better investment. Year 10, side by side. Jake's house is worth $352,000. He owes $172,000. Equity, $180,000. He also spent an additional $25,000 to $35,000 out of pocket in repairs and carrying costs beyond his down payment. Marcus's portfolio, $197,000. Total invested, $86,000. The other $111,000 is pure compound growth he never had to manage. Almost even. Jake slightly ahead because of leverage. But Jake worked for every dollar of that lead. Year 15. Marcus pulls ahead for the first time. Jake's equity, $270,000. Marcus's portfolio, $347,000. Compounding at 15 years starts doing the heavy lifting that no rental spreadsheet can replicate. And Marcus still has not made a single call about a broken anything. Year 20. Jake's equity, $383,000. After 20 years of real costs, repairs, vacancies, the renovation in year 17, the property manager he finally hired in year 16, his net return above all real expenses lands somewhere between $40,000 and $80,000. Marcus, $594,000. He put in $122,000. The rest is compounding he never touched. Marcus won on returns. Jake is not far behind, but Jake worked 6,000 hours for the privilege of being close. Year 20. Jake opens the spreadsheet one more time. He has always known the mortgage number, the repair costs, the vacancy months, the renovation in year 17. The number he never put in was his own hourly rate. Here is what 20 years actually teaches you. Real estate is not passive income. It is a business. The people who win at it know that going in. They hire property managers, reserve 1% to 2% of the home's value every year before they spend $1, and underwrite every deal on real costs, not the number from the meetup. Jake did none of that. Most people who buy their first rental property do not. Marcus, for his part, watched his portfolio fall nearly 40% in 2009. He did not sell. He did not call anyone. 4 years later, it had fully recovered. His worst enemy was himself, and he just had to stay out of his own way. Jake's worst enemies were a roof, a furnace, a water heater, 3 different tenants, and his own time. The investment was not the mistake. Pricing his own time was. That is the one number the real estate meetup industry never put on their calculator, and it is the one that changes everything when you finally run it. Year 20. Same lunch spot, same two guys. Jake has a paid-off house and a spreadsheet full of receipts going back to 2006. Marcus has a brokerage account and one folder of tax documents. Both built serious wealth. Both made it. The rental property paid Jake, but every payment came with another shift. Marcus never collected rent. He collected time. They are both wealthy. One of them has 6,000 hours he will not get back. Jake did not buy a house. He bought a second job. He knew it by year 12. He just did not say it until now. That's the Ben factor.